All right, good afternoon, everyone. Right now, we're going to go over the process of calculating a bid price problem. The bid price problem is a really good problem to kind of test your overall understanding of all of the different concepts of Chapter 10. It involves using the pro forma spreadsheet, cash flow analysis. You have to calculate net present value and IRR, as well as using the tax shield approach. So to start off with, I'm kind of just going to go over the basics of how we have our spreadsheet set up. Anything you see in yellow is going to be an input, and anything in blue, I have a formula outlined in, and anything in orange you see is kind of like outlier in terms of formula-wise, and obviously we're going to go over the details of all of these. So the question that we're doing is Chapter 10, Question 18 from the end of the book. I'm just going to go ahead and read the problem, and you'll see in the problem we have the important data points highlighted or underlined and bolded. So calculating a bid price, Dahlia Enterprises needs someone to supply it with 120,000 cartons of machine screws per year. To support its manufacturing needs over the next 5 years, and you've decided to bid on the contract. It will cost you $870,000 to install the equipment necessary to start production. You'll depreciate this cost straight line to zero over the project's life. You estimate that in 5 years this equipment can be salvaged for $70,000. Your fixed production cost will be $325,000 per year, and your variable production cost should be $10.3 per carton. You need an initial investment in net working capital of $75,000. If your tax rate is 35% per year and you require 12% return on investment, what bid price should you submit?
Okay, so we will be starting with the input values. The first thing we will be looking at is the cost. Just the variable cost based off the problem is 10.3, and then the project quota, which is just a calculation of the number of units per year times the number of years.
So the number of units per year is 120,000, which gives us a project quota of 600,000, which gives us the total variable cost per year of 1.236 million. And then our fixed cost per year will be the 325,000 per year, which shows the variable cost being populated over here in yellow.
Okay, so now that we have our costs populated, you can see that the next row, line 19, or gross profit, is automatically populating. The gross profit is going to be the revenue, which we have still yet to determine, minus the cost. So you can see that formula there is just populated, and we have the cell as well as the actual formula given over here. The next input that I'm going to derive is the capital spending. Capital spending is any type of investment that you have to make in equipment-wise, land-wise, anything like that. So that's why right now we have land cost. As you can probably see in the problem, we didn't have any land. So we're just going to go ahead and put the 870,000 of equipment cost, and you can see the total capital spending year one is 870,000. This needs to be negative. Okay, so cost is a negative, and then down here you can see that the depreciation populated. So let's go ahead and put in our depreciation years, which is 5. It says it's going to be straight line to zero over the project's life. So we know that the project's life is 5 years, and the depreciation per year is pretty much just going to be the total depreciation cost, the total equipment cost divided by 5. So that's 174,000. And you can see that's populated over here in line 21. You'll see that right there. The next item that I'm going to put in is the salvage value of the equipment. The equipment salvage value before tax is listed in the problem as $70,000. So we're going to go ahead and list that $70,000. And you can see here I have the salvage value after tax calculating. So the salvage value after tax is the salvage value before tax times 1 minus t. So if we populate the tax rate, which is 0.35 as listed in the program, as listed in the problem, we'll see that the after-tax salvage value is 45,500, and we'll show you where that comes into play later on in the problem.
Okay, so after variable costs, capital spending, and depreciation are filled in, we'll be going EBIT, taxes, and net income are calculated. So as we can see here, EBIT is calculated by adding gross profit, capital spending, minus depreciation, which you can see over here. And then taxes is just EBIT times the tax rate, and net income is just EBIT minus taxes.
To complete the top portion here, which is essentially the pro forma spreadsheet, we can move on to calculating the cash flow section. So line 27 is the operating cash flow, and that's equal to the depreciation plus the net income, which you can see shown here. And the only thing that's different about this line is in the last year.
Just let it go.
In the last year, you're going to actually pull the operating cash flow from one of the previous years, because we're going to calculate this difference down here in the different in the changes in net working capital and net capital spending. So changes in net working capital. This is another input that we need to add. You'll see we have it down here in yellow, so that's where we're going to populate it. The problem states that you're going to require an initial investment of net working capital of $75,000. We're going to enter that as negative. If we had an additional net working capital per year, you would see that populated in these columns. It's always assumed that all net working capital is regained at the end of the project. So that's what we'll see populated here in G28, which is just going to be the sum of all the net working capital that was invested over the life of the project. The next line, line 29, is the net capital spending. And you'll see that we just pull down our initial net working capital spending from B20 up here. You don't populate anything else unless you've invested net capital spending over those years. And then the last item is going to be a familiar number for some of you that have been paying attention. You'll see over here when we calculated the after-tax salvage value of our equipment, it was $45,500. So you can either calculate it like that if it was given, or the after-tax salvage value, the after-tax value of your net capital spending is going to be the difference between your net income in the last year of your project versus the year before. So as you can see, the last line here is the cash flow from assets, and is just the sum of your operating cash flow, your change in net working capital, and your net capital spending.
Alright, so after cash flows, we will be calculating the net present value, which is basically NPV, and then D35, which is the discount rate, which is your required return on investment, which is the 12% over here. So let's fill that in. And there's our net present value. And then our IRR, internal rate of return, which just looks at your cash flow from assets per year.
We're going to revisit the net present value in IRR when we come back after we've finished the tax shield approach, which is going to leave us with our sales that we're going to go ahead and populate back up here. So in order to start the tax shield approach, you need to first calculate the CFFA for the project. And that is the present value of your future net working capital and your future net capital spending, subtracted from your initial net working capital and initial net capital spending. So that's going to give you a negative number. From that, you're going to calculate your operational cash flow. And we do that using the payment equation in Excel, which is going to evenly distribute that cash flow. Next, you're going to calculate your net income by taking your operating cash flow and subtracting depreciation. So you can see that formula there. Then you can calculate sales by taking the net income and dividing it by 1 minus the tax rate plus cost plus depreciation. And you'll see that formula there. So once we have that, that's going to give us our revenue rate, which we can go ahead and populate up there. And when you divide that rate by the number of units per year, you get your bid price of 15.35.
Okay, so an alternative way to solve for the bid price per unit is to use Excel Solver. So first you would just set the objective, which is the net present value, to equal the value of 0 by changing the variable cells of the bid price per unit. This and then Excel Solver gave us the 15.35, which matched our calculated bid price per unit of also 15.35. And then the solver solution of the sales, which is just the bid price per unit from what solver gave us times the number of units per year. This then populated the projected revenue from the bid, as you can see here, and gave us a net present value of 0, and also the internal rate of return ended up matching our discount rate, which then just completed our problem.